Hi, my name is Richard Flahive, CIO and partner at Hightower Westchester. And today I want to introduce you to an interesting strategy for purchasing real estate called delayed financing. If you're looking to stay competitive in today's market while keeping your cash liquid, this could be a financial game changer. So what is delayed financing? It allows you to buy a property in cash upfront and then secure a mortgage afterward. It's like getting a mortgage in reverse. This strategy is similar to a cash out refi, but without the 6-month waiting period. So here's how it works. First, you need to come up with the funds to buy a home in cash. You might use savings or other assets, sell other assets such as stocks or properties. But after purchasing the home, you then apply for a mortgage. You'll obviously need to provide financial information such as proof of employment and undergo a credit check. But as with any financing, borrowers must maintain that integrity of their credit and employment status between the time when they buy the home and when they get their mortgage. So why would someone choose delay financing? What are some of the benefits? Well, number one, faster closings. Sellers often prefer cash offers, which can speed up the home buying process and make you more competitive. Two, liquidity. You can regain your access to your capital after securing the mortgage as the lender disperses the funds in one lump sum. And three, better leverage. You can use that cash for other investments or emergencies. Imagine finding your dream home in this extremely hot market. Paying cash can help you ensure you win that bid. And then once the dust settles, delayed financing lets you recover that cash and spread the cost over time. Now, the question is this strategy right for you? This strategy is beneficial for those who have cash on hand, but want to maintain flexibility for other financial goals. It's great for those with financial reserves in liquid assets or outright cash. You don't necessarily have to sell the stocks or bonds to come up with the money. There are certain strategies buyers can use, such as leveraging your investments for delayed financing. For example, here at Hightower Westchester, you can take out margin, borrowing money against your securities, with the securities as held as collateral. And this, quote unquote, line of credit can be funded really as soon as the next day and remains open for future use while adding leverage that can amplify both profits and losses while outstanding. In this scenario, you're not selling anything, so no capital gains are incurred because the assets are obviously being held, and no profit is realized. Borrowing against those assets can be a better strategy than often liquidating outright, which can obviously incur taxes. And you can then fund it back once you secure the cash. With that said, there are a number of things to consider. First, debt to income ratio. Be mindful of your debt to income ratio, especially if you plan to make significant changes to the home. Second, ensure the purchase is an arm's length transaction. Now, this is important. You want to avoid allegations or tax or mortgage fraud. An arm's length transaction means that you don't have a pre-existing relationship with the seller. Delayed financing is also useful for investors looking to purchase multiple properties without tying up all their funds, a little bit more speculative in nature. And finally, let's talk about some of the risks that obviously come with this strategy. So this strategy, like most, carries risk of higher interest rates, potentially on the refi, and the potential for a lower appraisal value, and the lack of short-term liquidity. So let's talk about these a little bit more. You might find higher interest rates on the cash-out refi loan compared to what you would have gotten with a traditional purchase loan. As far as the appraisal value fluctuations are concerned, the property's appraisal value at the time of the refi could be lower than the purchase price, meaning you might not get back all the cash you initially used. And obviously the lack of liquidity, right? Your cash is tied up. You'll need a substantial amount upfront, and it might be tied up for a period, potentially leaving you with some limited funds for other needs. Delayed financing can really be a powerful tool when used wisely. If this sounds like something that might be right for you, please reach out to us or your lender, and we can happy to help you. Thank you.